So that they can.
Okay, folks, I think it is noon, so we should get started because I want to get out of here by 1 because there's other stuff going on here. I know there's a private equity conference. This is great, actually. This is like a personalized session. It's actually funny. I used to teach my valuation class twice every year for 21 years in this room. It feels so cozy after Paulson. You can actually see people now. So let's get started. Okay, first quiz is a pretty compact one. Compact one in what sense? There are 3 basic issues that I want you to kind of get. So when I'm writing the quiz, here's what I'm trying to figure out whether you get. Okay? The first is, in any modern corporation, there are all these different groups with different interests. So if you look at the first 4 sessions, it was about all those conflicts of interest that embed the managers and stockholders and bondholders in society, and how you get balances. So that's going to be the first thing I want to check, is whether you get a sense of those conflicts of interest. One of the problems, of course, in that arena is it's really not about numbers. It's more about making subjective judgments. So if you look at the first question on pretty much, how many of you have looked at past quizzes yet? Okay, good. The first question in every past quiz is a multiple choice question, right? It's the only multiple choice question you will ever see in this class. I hate multiple choice questions for lots of different reasons. But on this particular topic, you get multiple choice questions. And I'll take you through a couple, and I'll give you a sense of what I'd like you to do, because if you wear different hats as you're approaching these questions, you're going to get really confused. Second, if I gave you a regression of stock returns against a market index, a Bloomberg beta page, I want you to be able to take it apart and tell me what the different pieces of output tell me about the company. What does the intercept tell me? What does the slope tell me? What does the R-squared tell me? So it's reading a regression. And the third part, and of course, whatever beta you get out of that regression, you've got to be able to use to come up with a hurdle rate, bringing together the risk-free rate, the risk premium. But the last part of this session, and this is where I think you run into the question of, do you really get it? Because it's not just about mechanics. Is this notion of bottom-up betas. The beta for a company doesn't come from a regression, it comes from choices the company makes. What business to be in, how much to borrow, what fixed cost it has. And essentially the last part is whether you're comfortable with that notion and being able to move back and forth between the beta of a business and the beta of the stock, the beta of cash and the beta of operations, all those different pieces. So hopefully by the end of the next 45 minutes, even if you haven't reviewed anything for the quiz, you will have a better sense of what to do next. So let's start with that first question about conflicts of interest. As I said, almost every one of the quizzes, the first problem is a set of multiple choice questions. Here's what I want you to do. As you read the problem, because there are so many different players, you can look at the same thing from different perspectives and have different choices. I'll ask you to wear a hat. Are you a stockholder? Be a lender. So in a sense, put that hat on, and everything you read in this problem should be about how you would look at this decision given the hat you wear. So let's take an example. Assume you're currently the stockholder in a firm that is being targeted in a leveraged buyout. So I'm asking you to wear the stockholder hat, right? Put the hat on. From the perspective of conflicts of interest between you and those people doing the transaction, which of the following is most likely to trouble you. So it's all about you. Forget about the rest of the world. I'm not asking are LBOs good? Do they create value? You don't care about any of this. This is all about you as a stockholder. You ready? I'm going to list out the things, and you tell me whether this would bother you as a stockholder in the targeted company. The fact that the company will go private after the transaction. Are you worried about that? Why not? Because you're going to get paid, you're going to leave. Who the hell, you really don't care what happens to the company afterwards. You say, but society will care. You're not wearing the society hat now, you're wearing the stockholder hat. As a stockholder, you couldn't care less. Are you really upset about the fact that equity investors in the LBO might make a really high return? Why be greedy? You're making a high return too. So the fact that KKR makes a lot of money is not going to, you're not going to lose any sleep over it. How about the fact that your own management might be part of the team trying to acquire you? See why that might be a dangerous thing? Tell me what might happen. Play out this perverse game. What could managers do to make life easier for themselves leading into an LBO? Knowing that they're going to be on the acquiring team, what do they want? They want the value to be low or high? They want it to be low. So in the year before, what are you going to do? You're going to do some really stupid things in the company. You're going to say, if you don't agree to this, we'll run the company to the ground. Bad news will come out about the company all over the place. That's the choice you would make here. Please, on these multiple choices, pick only one choice. Don't hedge and circle for it. I was thinking about that one the most. No, that's not going to fly. If I see more than one circle, it's an automatic no, because it says which would concern you the most. So if you're concerned about the other things, I don't care. This is the one that concerns you the most. Let's take the second one. And this is really about understanding what an efficient market is. And I'll be quite honest, most people who talk about efficient markets have no idea what it actually means. So this I'll probe you to see, do you get this? We know that stock prices of target firms and LBOs jump on the announcement of an LBO. About 15–20% jump. Can we view this as evidence that markets are inefficient, markets are efficient, or can you not pass judgment yet? See the question I'm asking? In an efficient market, can stock prices jump? Let's take that question. In an efficient market, can stock prices jump? What could cause them to jump? And what is it about the announcement? Because remember, in an efficient market, prices should jump only because value has jumped, right? An announcement by itself, if it causes price to jump and the value doesn't change, is not an efficient market. So for an efficient market, you have a tougher standard to meet. Not only do you have to show me prices jump, but that there's a chance that the value could also jump. So here's the question I'm asking. Can an LBO cause the value of a company to increase? So tell me how it can increase. What are the things that can make the value go up?
Well, if there's better management that's going to be run.
Okay, first is remember the company is going to be run differently. You're hoping it's going to be run better. KKR or Blackstone will run it better. What else? What's the L in the LBO tell you? There's debt coming into the game, right? Debt by itself can cut both ways, but to the extent that this is a company that could afford to borrow money and it's not, you're taking advantage of the tax law. That's it, that's all you need. As long as there is a chance that the value can jump, then the fact that the price jumps can't be viewed as a sign of inefficiency. Can it be viewed as a sign of efficiency? Not unless you check to see. So in this case, the right answer is C, because until I look at who's coming into the company, what they plan to do, just looking at the price jump will not let me pass judgment on whether markets are efficient or inefficient. So on those efficient and inefficient questions, the judgment call you're making is, can a price change reflect something real happening in the company, or is this really an irrational market that's playing out? And that's basically going to be the dividing line. Any questions on anything to do with that first section on conflicts of interest? So take those past quizzes, work through that problem one across the board. In fact, just do the problems one across the quizzes, because you'll start to see patterns that maybe you can use when you look at those 4 multiple choice questions that you have on this exam. And also, please remember, these multiple choice questions are worth a half a point apiece. Do not spend 20 minutes of the 30-minute quiz reading and rereading and rereading the multiple choice questions. If you're confused, circle something randomly, move on. Okay? It's better to do that and come back to it than to get to problem 2 and say, I have only 8 minutes left on the quiz. Okay? So don't look for tricks, just pick an answer and move on. It's better than kind of sitting there. My daughter has this problem with the SAT, it killed her. She could not make a decision. So should I go there? Should I go there? I try to explain to her the laws of probability, which is once you've narrowed it down to less than 4, you might as well go ahead and guess. You're better off than not guessing at all. So once you've kind of narrowed down the answers, if you're running out of time, just make a choice and move on. Now let's take, yes, go ahead.
Having learned about like strong form, weak form, it's like that's a bit confusing to have it in your head.
Efficient, inefficient. Strong form, weak form. I didn't even think I ever mentioned this in class. Do I even have it in the book? This is not my language, right? You're either efficient or you're not. Okay? Efficiency basically means that prices reflect something fundamental change in the company. Inefficiency means that it doesn't.
In the long term.
Again, I didn't mention anything about time horizons, right? So value is value. We have to figure out what value is because we've kind of left it fuzzy right now. But there is a change in value. The reason for the change in value might be way out in the future, but value changes instantaneously. So if you're a growth firm and you do something right now that's going to improve your cash flows in year 10, your value changed immediately. It doesn't wait till year 10. The question is, does the price change as well? Now let's talk about reading a regression. It's like statistics, right? You run a regression. It's a simple regression. One dependent variable, one independent variable. Remind me again, what's your dependent variable? The return on the stock. The independent variable is the return on the market. You run the regression, you get 3 pieces of output. You get the intercept, you get the slope, you get the R-squared. Let's start with the intercept. What does it tell us? It tells us whether your stock was a good investment during the period of the regression. Keyword is was. Why does it tell us that? If I compare the intercept, which is what I actually see in your regression, to the risk-free rate times 1 minus beta, which is what it should have been if your stock had done exactly as predicted, the difference between those two numbers is a measure of whether your stock did well or badly. That's your Jensen's alpha. The one mechanical thing you've got to be careful about is if you run your regression using weekly returns, your risk-free rate has to be a weekly risk-free rate. If you run your regression using monthly returns, it's got to be a monthly risk-free rate. It's one equation, right? Remember Algebra 101? You have one equation. How many unknowns can you have? What's the most I can give you as unknowns? 1. Remember that. Every Jensen's alpha problem, I've got to figure out a way to give you 2 and make it look like I have it. Right? That's the trick, because if I just gave you 2 of the variables, you just have to plug them, checking your algebra. So if you can't find that second variable, you haven't looked hard enough. So let's take an example. Okay? So the key concept, as I said, is match up time periods. So when you read the problem, read the part about the regression carefully, because I'm going to tell you whether I use weekly, monthly, daily, because that's going to matter in how you compute Jensen's alpha. So here's a problem from I don't know when. Said I've run a regression of a stock. I make up an end, dividends, against the S&P 500 using monthly returns. So just underline the word monthly as you're reading it, because that's going to matter in how you do your risk free rate. Over the last 5 years, arrived at the following regression. Minus 0.20% is the intercept. That's what actually happened. 1.50 is the slope against the S&P 500. I then tell you the stock has a Jensen's alpha of plus 0.10%. So basically I tell you the stock did 0.10% better than expected during the period of the regression. So I've given you 2 of the 3 variables, right? The 2 variables I've given are the intercept and the Jensen's alpha. I'm asking you to solve for the risk-free rate. It's an algebra problem. Okay? Intercept minus the risk-free rate times 1 minus beta. The beta is given because it's in the regression. That was the kind of variance. And where the heck is the beta? It's right there. The slope of the line is equal to the Jensen's alpha. You solve for the risk-free rate, you get a risk-free rate of 0.6%. That's going to be my monthly risk-free rate. Why monthly? Because I use monthly intercept. I've got a monthly risk-free rate. I think the problem asks you to compute an annualized risk-free rate. If you're in a hurry, what should you do? Multiply by 12, move on. Right? If you're not in a hurry and you can do it right, it's going to be 1 plus the risk-free rate. The reason I want you to be careful here is, remember, it's not 0.6%, it's 0.006. So you make it into a decimal. It's 1.006 raised to the power 12. Why? Because it's monthly. I get 7.44%. I got 7.2% when I just multiplied by 12. I get 7.44% when I compound. That's always going to be the case. Compounding is going to have a small effect. That's going to be my annualized Jensen's alpha. Any questions? So any intercept Jensen's alpha problem, check the returns in the regression, see what interval I use, make sure your risk-free rate is in the same interval. In this problem, I could have given you the Jensen's alpha on an annualized basis instead of giving you the monthly Jensen's alpha. Again, you can take the shortcut, divide the annualized number by 12 to come up with the monthly Jensen's alpha, or take 1 plus the Jensen's alpha, 1.024 raised to the power 112. You get almost the same number, 0.0198%. So again, compounding and not compounding, I will leave it up to you. If you feel comfortable doing it, go ahead and do it. If you don't feel comfortable doing it, just multiply by 12, multiply by 52, divide by 12, divide by 52 to go from annual to weekly to monthly. Yes, question?
Which item, if any, on a Bloomberg beta regression should be read or can be read as the intercept?
Okay, the question was which item? It's actually called alpha, in brackets says intercept right next to it. So that will be the intercept. The only thing about Bloomberg is it's very sloppy about percentages and decimals. So when you look at the Bloomberg intercept on the Bloomberg page, it's actually already in percentage terms. So when it says 0.31, it's not 31%, it's 0.31%. Don't ask me why they do it, but that's the way the Bloomberg beta page should be read. So everybody comfortable with intercepts and Jensen's alphas? Now let's talk about going from betas to expected returns. To go from betas to expected returns, I need two other numbers. I need a risk-free rate, and I need an equity risk premium. What risk-free rate should you use? Should be the risk-free rate in whatever currency I ask you to do the analysis in. Notice what I said. I didn't say what country the company is in, what currency I choose. So as you read the problem, you're saying, what currency do you want the expected? That's going to determine the risk-free rate. The risk premium should be a weighted average of the risk premiums of all of the countries that the company operates in. And of course, to get to the risk premiums for risky countries, you've got to start with a mature market premium, which I will either have to give you, or if you've looked at some of the earlier quizzes, pre-2003, I used to let people tell me what the mature market premium was. He said, how the hell would I be able to do it? It's open book, open notes. You go to the table for the US, you look up the premium. I've stopped doing it because I've discovered that people can look up all kinds of numbers in that lecture note packet. People would look up page numbers and put it in as the equity risk premium, which is a nightmare for me. 198% premium. Where do you get that? Oh, that was a page number. I was in a hurry. So since 2003, I've kind of at least given the base number so that we're at least starting with a constant and then working out. But if I forget to give you that number, don't freak out. I just gave you a free lunch. Go out and look up a number that actually is a number that you can use. A historical premium, 4.54%, and move on. So now let me take an example again to kind of bring this home. This is from a regression from 5, 6, 7 years ago of Cemex, a Mexican cement company run against a bolsa. So there's a regression equation, intercept, slope, R squared. Okay. I'm not asking you, is this a good regression, bad regression? You can get caught up in that. Assume that the beta from this regression is correct. So I'm saying take the beta as right, and I ask you to estimate the cost of equity in Mexican pesos. That's critical. The reason I've underlined it is just because it's a Mexican company doesn't mean the cost of equity has to. I could have asked you to estimate it in US dollars, in Brazilian reais, in euros, and Swiss francs. In this case, I want you to estimate it in Mexican pesos. And then I give you one final piece of information. The 10-year Mexican government bond rate denominated in pesos. So again, keep reading when you see Mexican government bond rate. I could have given you a dollar bond, but in this case, I've given you a peso bond. The rate is 8.35%. But I keep going. Mexican government has a local currency rating of AA. What does that mean? What am I telling you? You cannot use the 8.35% as a risk-free rate, right? That's implicitly what I'm saying. And I'm saying the default spread associated with that rating is 0.65%. The risk premium for US and other mature markets is about 4%, so I've given you the base. And Mexican equities are 3 times more volatile than the Mexican government bond. You say, what does that even mean? I want you to get an equity risk premium for Mexico, right? I've given you the default spread for the Mexican bond, and now I'm saying equities are 3 times more risky. So let's break this down. I want a cost of equity in pesos, so the first thing I need is a risk-free rate in pesos. So I take the 8.35%, I subtract out the 0.65%, my risk-free rate in pesos is 7.7%. Everybody comfortable with that? Because that's going to be one of the central things in that second problem is if I ask you for a cost of equity, you need to be able to come up with risk-free rates in currencies where there is no AAA entity issuing bonds in that currency. That's my risk-free rate. For the risk-free rate, risk premium in Mexico, I took my base premium of 4%. That's for the US. I took the 0.65% default spread, the same spread. I multiplied by 3. Why 3? Because in the problem I said equities were 3 times more risky than bonds. I came up with an equity risk premium for Mexico, an additional premium 1.95%. You add those two numbers up, the equity risk premium for Mexico is 5.95%. I'm home. Risk-free rate plus beta times, the beta came from the regression 1.08, times 5.95% is a cost of equity of 14.13%. Now in the problem, I didn't give you a geographic breakdown, but let's suppose as part of the problem, I told you that Cemex gets half its revenues in the US and half in Mexico. You know what you'd have to do? You'd have to take a weighted average of the US premium, that's a 4%, plus the Mexican premium, which is 5.95%. That'll now, so remember when you do equity risk premiums, it's not where the company is incorporated that drives your equity risk premium, it's where it does business. And I'm not going to go crazy and give you 16 countries. I know it's a 30-minute quiz. If you can do 3, you can do 16. So it will be minimalist, but you have to be able to deal with currencies where there is no default-free entity and companies that operate in more than one country. Any questions on this? So now let's turn to the meat and potatoes part of this quiz. Regression betas come from statistics, right? You run a regression, you get a slope of the line, say, I've got my beta. But we also said betas don't come from regressions, they come from how you do business. What kind of business you're in. More discretionary businesses have higher betas. But remember again, betas measure not total risk, but market risk. You can be a risky company with a low beta. How? If all your risk comes from doing something that affects just the firm, it has nothing to do with the market, you can end up with a low beta even though you're a risky firm. So here are the 3 things. The first is what type of business you're in. More discretionary businesses should have higher betas than less discretionary. Tiffany's should have a higher beta than Macy's, and Macy's should have a higher beta than Walmart, because in the chain of things you would expect the more discretionary a company becomes, the higher the beta would be. Second, the greater the proportion of your costs that are fixed costs, the higher your beta. And third, the more you borrow, the higher the beta for your stock will become. So what I'm going to do actually is take one problem from way back. I'm going to do the problem as it was asked in the quiz, and then I'm going to throw every conceivable variant that I've ever written in any quiz into this problem. So by the time we're done with this problem, everything you see in any quiz should be somewhere in this problem. So if you get stuck early in the problem, make me untangle it, because otherwise as I start building things, you're going to freak out. So this was for, I've asked you to estimate the levered beta. So I've just cut out a portion of the problem that's a much longer problem. The levered beta for GenCorp, a corporation with a food business and a tobacco business. So it's in 2 businesses. The tobacco subsidiary is worth 15 billion and the food subsidiary is worth 10 billion. You should be dancing now because I made your life easy because I've already given you the values of the 2 businesses. What else could I have done to make life more difficult? I could have said, I don't know what the value is, but you get 60% of your revenues from one business and 40% from another, and I could have given you other information you can use to estimate the value. Remember we did, no. In this case, I've given you the values already. So this company is 60% tobacco and 40% food. Everybody with me so far? Okay. I also told you in the problem that the debt to equity ratio for this company is 100%. You know what people got stuck on this problem? They said, you didn't give us the debt and the equity. So I'm going to suggest a device that I find very useful when I think about bottom-up betas. You're welcome to use it if you want. You're welcome to abandon it if you don't. I draw up a financial balance sheet. One of the great things about a balance sheet is the asset side and the liability side have to equal out, right? I've got the two items on my asset side. This is a financial balance sheet. It's not an accounting balance sheet. I've got 15 billion for tobacco and 10 billion for food. So the value of this business is $25 billion. Everybody with me so far? Not the value of the equity, but the value of the business. What did I tell you about the debt to equity ratio? For every dollar of debt, there's a dollar of equity. If the total value of the business is 25 billion, debt has to be 12.5 and equity has to be 12.5. You've got your financial balance sheet to start the game. Okay? So nice thing about balance sheets, if you make a mistake and the balance sheet doesn't balance, then you can always go back to what did I miss? What's going on here that I'm missing? So I got my debt, got my equity. So the first part of every one of these problems, it's almost patterned, is I ask you to estimate the levered beta for this company. In fact, I'm going to tell you something right now to save myself some trouble during the quiz. If you see a problem and I say estimate the beta for the company, unless I specify otherwise, the beta that I want you to estimate is always a levered beta. If I want you to estimate an unlevered beta, I'll go out of my way and say estimate the unlevered beta. If I give you an unlevered beta, I'll tell you this beta is an unlevered beta. So if you see the word just beta, nothing in front of it, it's always a levered beta. So I've got your two businesses. I also give you what the beta is for other publicly traded companies in each of these businesses. In the food business, I went and found food companies. The average beta, remember what I said, that's a levered beta for these companies is 0.92. The average debt to equity ratio for other food companies is 25%. The average levered beta for tobacco companies is 1.17 and the average debt to equity ratio for tobacco companies is 50%. Now why am I giving you that? Because you want to estimate a beta from the bottom up. You've got to estimate a beta for being in the food business and a beta for being in the tobacco business. So somebody help me out here. What would I need to do to get a beta for the food business? Yes, go ahead. So give me the number. So I'm going to use 0.92 as my levered beta. What debt to equity ratio am I going to use?
25%.
Why am I using the 25% rather than the 100% I have as debt to equity?
Because it's the average debt to equity ratio of that industry.
In other words, while you're in the food business, remember your company is not even playing this game yet. This is about the food business, and in the food business, companies have a 0.92 levered beta and a 25% debt to equity. If I unlever the 0.92 using a 25% debt to equity ratio, the tax rate was given to be 40% in this problem. Don't forget the tax rate. I get an unlevered beta for being in the food business. A couple of small things that might help you as you go along. When you unlever a beta, it should always go down. So check your numbers as you go through. If you're unlevering, you're in a hurry, you get a higher number, something is wrong. Your brackets are off, you didn't do it right. So the unlevered beta is 0.8. I do the same thing for the tobacco business. My unlevered beta is 0.9. So I have an unlevered beta for being in the tobacco business and unlevered beta for being in the food business. You want to make life a little more difficult? In this case, I gave you the beta for being in the tobacco business and the debt to equity, right? What if I told you that in these businesses, companies have roughly 10% of their value in cash? First thing I'm going to ask you is about direction. I estimate an unlevered beta for the two businesses acting like they have no cash, right? I said that's the beta. But what if I told you that 10% of each food company is cash and 10% of each tobacco company is cash? Have I underestimated the unlevered betas or overestimated them? Let's start at the algebra, right? I know you can't even read this here, but let's go. So you have 10, 90. Let's take a food company. So its food is 90, cash is 10. And right now, what's my unlevered beta for the company? The unlevered beta I got was 0.80. So company unlevered beta is 0.80. And this is 100. So what's the beta of cash? I'm sorry, 0. What am I solving for? I want to get a beta for just the food business. So let me ask you the question again. I got an unlevered beta for the company, it's 0.80. 90% of the company is food, 10% is cash. The cash is actually pushing my unlevered beta for the company down. So if I take cash out, what's going to happen? It's going to go up. In fact, algebraically, all you have to do is take the 0.80 and divide by 0.9. Do you see that shortcut that I use? Basically what I'm saying is 90% of this company is food. If the 0.80 beta comes from this company, the true unlevered beta for food should be 0.8 divided by 0.9, which is going to give you like 0.88. So if you're given all three numbers for your sector, levered beta, debt to equity, and cash, you can either do it this way, or what's the other shortcut I suggested you could use? What if I told you the debt ratio is 40% and cash is 10%? You take the debt and you net it out against the cash, you end up with a net debt ratio. If you want to use the net debt ratio, that's fine. I can live with that too. But you have to deal with cash somewhere along the way to get an unlevered beta for a company. Any questions on? So, yeah, go ahead.
In this case, are we saying that the 10% of the cash is 10% within the food business component of it?
No, it's just the company, right? All you got is a beta for the company. All these betas come from companies. Remember how we did the movie Companies? These are all food companies. I averaged the betas out. I got an average beta for a food company, 0.92. I averaged the debt to equity ratios out. I got an average debt to equity ratio for the food company. So what I have there are unlevered betas for food companies and tobacco companies. Now I'm telling 10% of each company is cash. I have to take that out of the process. So you never get a beta for a business when you do unlevered betas from companies. You have to make some assumption about cash somewhere along the way. Any other questions? So at this stage I have an unlevered beta. Here's what I'm going to do. Yeah.
So in this case, you would subtract the 10% of the 25 millions.
To get a net, if you want to go the net debt to equity, that's what you do. You use a 15% net debt to equity for food, and you use a 40% net debt to equity for. No. So basically, you'd have to go through that process of netting things out. Now let's talk about how this plays out for the company. So I've got two businesses, right? So I'm going to go back to the 0.9 and 0.8 because I threw the 10% as just as a what if. I've got my two businesses. I've got the unlevered beta for the two businesses. The unlevered beta for the company is always a weighted average. This is all weighted averages all the way through. Whenever you work with betas, one of the nice things is it's always a weighted average. So the unlevered beta for being in this for this company, given the business it's in, is 0.864. They're based on the weights. They have $12.5 million in debt and 12.5. So that if I ask you what the unlevered beta for this company is, it's 0.864. Now let's compute the levered beta. To compute the levered beta, all I need to do is bring in the debt to equity ratio, which is 100%, and the levered beta that I have for this company, given the fact that they've borrowed so much money, is 1.376. Always do the unlevered beta first. Never work with levered betas. When you do these weightings for businesses, always go back to unlevered betas. Otherwise, strange things are going to start happening to your final beta computation. That's the beta that I would use to come up with the cost of equity for the company. Yes?
So did we assume that the debt was the same in each business then?
You didn't have to, right? You just took the average, because you averaged. The regression betas were not the same for every company. They were 0.98 for one and 0.83, 0.75, 7. So in a sense, we average the betas, we average the debt. If you want to use the median for one and the median for the other, that's fine too. Because each company is going to have its own number, right? So when you average, you're saying that's what a typical firm in this business now has a beta, debt to equity, and a cash balance.
But for this particular business, when we weighted back up the unlevered beta and then did the debt to equity ratio,
Yeah.
so you're saying that if you did have information about the debt in food food of this particular
You
company?
could have different levered betas for each. If I had asked you, because your final answer would still be right, 1.376, because that's all the prom has, so that's not going to change. But then if I'd asked you what the cost of equity should be for a project in the food business, and I gave you a breakdown of where the debt was, then it gets a little messier, right? But then I'd have to give you other information to be able to get the values of each business to be able to get to a debt to equity ratio. Yes?
Just a question of clarity. When you have the cost of equity equation, you have 6% and 5%, 5.5% right in the equation. Are you actually using 0.06 and 0.055, or are you using?
Just stay consistent. If you do 6 and 0.055, you're going to be off to there. So if you go percent, and that's actually a good point, is if you're comfortable with decimals, just stick with decimals. If you're comfortable with percentages, stick with percentages. As long as you stay consistent all the way through, you get exactly the same answer either way. But if you move back and forth, then everything's going to start coming apart. Any other questions? Yes?
Where's the 5.5% coming?
Remember I said pre-2003, I made you go look it up? So today I would give you that mature market premium. If I really wanted to make this problem really messy, I could put this company in 7 countries or 3 countries. No, that's why I have the second problem. So the third problem, I want you to deal with what beta. So, but if you had it all as one big problem, which is what your project is, and that's why I said your project is your ultimate experience for the quiz. Because I could never write a problem as complicated as any real world company. It's impossible for me to do it. So one reason I keep nagging on the project is I'm a natural nag. The other is I think it actually allows you to deal with much more complicated problems than any problem you can ever see on a quiz. So you ready? Now we're going to take this company apart. So now let's assume that the company divests itself of the food business. What does it mean? It sells off the food business. Yeah.
This unlevered beta, are we assuming that there's no cash?
I gave this cash, I'll tell you this cash, right? So I have to give you the information. So if nothing is given, don't assume a cash balance and make life difficult for yourself. So the company has cash, I'll throw the cash into the problem.
And I will touch all.
You're going to see that happen now because when I divest the food business, here's all that happens. So the minute after the divestiture, what happened? The food business has left the company and 10 billion of cash has come into the company. Nothing's happened to debt, nothing's happened to equity. It's amazing how often I see people say, well, I've divested a business, my equity should go down yet. No, nothing's happened yet. All I've done is change one type of asset for another. What's going to happen the second after this divestiture, I asked you to compute the beta, is your unlevered beta is going to go down. Why? Because 40% of your company is now cash. Your debt to equity ratio hasn't changed. Your levered beta as a company now will reflect a much lower unlevered beta, but the debt to equity ratio stays at 100%. So the levered beta is going to be 0.864. That's a lot of cash, right? Why keep 10 billion? So let's play with the cash. Let's do stuff with the cash. Let's see what it does to the beta. What if I told you I use the cash to pay off debt? I'm allowed to do that, right? Here's what's going to happen. The cash now leaves the company. The company becomes a pure tobacco company. The cash is gone. The debt drops by 10 billion. That's the advantage of having a financial balance sheet. Is if I take 10 billion out of the asset side, it's got to come out of the other side too. In this case, my debt drops by 10 billion. My debt to equity ratio goes from 100% down to 20%. My levered beta becomes 1.01. So if I use the cash to pay down the debt, my debt decreases, my debt to equity ratio goes down. So it's not the divestiture that affects my debt or equity, it's what I do with that cash that's going to determine what happens to debt and equity. So that's the first option, is to pay down the debt. What if I decide to buy back stock? Let's see what happens. Cash leaves the company again, my unlevered beta becomes just the tobacco company beta. My equity drops to 2.5 billion. Why? How does buying back shares reduce the market value of your equity? What does a share buyback do? You pay cash out, you buy shares back from the market, right? What happens to those shares that you buy back? You have a bonfire in your backyard and you burn the shares down. The reason I say that is in some countries, companies will buy back shares and keep them as treasury stock. You can't do that in the US. So when you buy back shares, you're reducing the number of shares in the company by however many shares you buy back. Now do you see why the market value is going to decrease? The number of shares decreases, the market value of equity will also decrease. Could there be a little signaling story that people read? There could be, but you're not talking about 2.6 versus 2.5 billion. The market value of equity goes to 2.5 billion. The debt to equity ratio now shoots through the roof. Why? Because you still owe 12.5 billion. Your debt to equity ratio now is 500%, and your levered beta reflects that. Yeah.
So that is a question about the age of the different firms. So in this case, it would be my idea to buy back because you have that amount.
There's nothing else to do with it. You could expand the tobacco business, but people are smoking less and less. But at least in this case, they're saying, well, the good days are over. We've sold the food business, equity's down. Any questions on this? Since we're on this path, let's make this even messier. What if I took the 10 billion, instead of buying back stock or retiring debt, I used $2.5 billion to pay a dividend and $7.5 billion to buy back stock. By now you can see the mechanics, right? I take 10 billion out of the asset side, it's got to come out of debt or equity. In this case, 7.5 billion comes out of debt because I've repaid 7.5 billion debt, and I'm going to take 2.5 billion out of equity. Let me ask you that question again. Why does paying a dividend reduce the value of your equity? I thought dividends were good.
Because their stock price is strong.
Because on the day the dividend gets paid, the stock price has to drop by roughly the amount of the dividend. Why? Sorry? Forget about retaining. This is a market reaction. I don't care what the accountant does, right? I want to ask, why would you as a stockholder expect the stock price to go down on the day of the dividend? No, it's a much simpler mechanical reason. Let's say it didn't go up. How? Because why would it go up? Because you pay dividends every 3 months. It doesn't, no.
Just taking the equity off the balance sheet.
Again, you're thinking too deep. It's very simple, right? You're thinking accounting, what happens to return on? Let's ask the question, what would happen if on the day the dividend, there's a day called the ex-dividend day, which is the day by which you have to buy the stock, buy to collect the dividend. What would happen if stock prices did not drop on that day? What would you do? You'd be buying the stock just before every stock goes ex-dividend, collect the dividend that day, sell it at the end of the day. If this were true, why are we wasting our time in class? We should be getting rich. We just buy stock. So it's to prevent that very simple arbitrage that on the ex-dividend day, if you look at any big dividend stock, there's $1 in dividend, the stock will go down by 97 cents. We'll talk about why not exactly $1, but the stock will drop by roughly the dividend. So what's happening is the company is shrinking. That's a retained earnings effect, but think of it just as a cash is leaving the company. It's not going to get more valuable, it's going to get less valuable. The equity will decrease by 2.5 billion. My debt to equity ratio now becomes 50%. My levered beta is 1.17. So we've looked at a buyback, we've looked at dividends, we've looked at retiring debt. That's pretty much everything you can do on the financing side. Now let's make life really interesting. What if I decided, instead of buying back stock or retiring debt, that I'm going to recreate my growth age? I'm going to go buy a social media company. What a tobacco company is going to do with a social media company, I don't know. Yeah. I'm going to buy a social media company. And I tell you that the typical unlevered beta for a social media company is 1.80. Now let's think of what's going to happen. You still have the 15 billion in tobacco. You now have 10 billion go from cash into the social media business with a beta 1.8. Your unlevered beta is now going to be a weighted average of the new business you brought into the game. It's going to go up to 1.264. Neither your debt nor your equity has changed. I often get questions from people saying, well, a company with cash goes out and buys another company. How does it affect the equity in the company? What's the answer to that? Nothing. You're not issuing shares. You're not going out raising anything. You're just going and converting one asset to another. So don't make this messy by messing with the wrong side of the balance sheet. Now, if you ask, is it a good acquisition or a bad acquisition, then you can have an effect on equity. Because implicitly, I'm assuming this is a fair value acquisition, right? If this were like Eastman Kodak and they paid a $3 billion premium that they should not have, then there's going to be a loss in value in the equity, because then your equity investors will decrease by $3 billion. In this case, all that's changed is my asset composition. You ready for one final variant? Let's try this. They have 10 billion in cash, right? They decide to borrow another 5 billion and buy a $15 billion social media company. So let's start on the asset side again, right? That's the easiest side. You now have 15 billion tobacco, 15 billion social media. So you have 50-50 split. Your unlevered beta is now 1.35. Your debt increased from 12.5 to 17.5 billion. That's the extra 5 billion. Your debt to equity ratio reflects that. Your levered beta is now going to be 2.48. We've, in a sense, we've done divestitures, we've done acquisitions, we've done buying back stock, paying dividends, retiring debt. That's pretty much it. Every problem you will see in every quiz, I'm going to use some combination of those 5. I won't make you do all 5, it doesn't make sense. But there'll be an acquisition and borrow money, acquisition and issue shares, divestiture and pay down debt, divestiture and pay a special dividend. Just keep the actions separate. In what sense? Look at the actions that affect the asset side, which will be acquisitions and divestitures. Look at the actions that affect the liability side, which will be retiring debt, issuing new stock, paying dividends, buying back stock. As long as you keep the two sides separate. And that's it, basically what we did with the Disney Cap Cities acquisition, right? We first computed the beta of the two companies after the acquisition, acting as if we didn't care about how it was funded. Then we said, tell me how it's going to be funded. Are you going to use debt? Are you going to use equity? So separate the business side from the financing side when it comes to estimating betas. And pretty much every problem you will run into on these quizzes is going to work itself out. So ready, we're going to take every conceivable action I can think of. And you're going to tell me how this action is going to affect the asset side of the balance sheet, how it's going to affect your unlevered beta. So I want you to think through the consequence of how it affects unlevered beta, how it affects debt to equity ratios, and how it affects levered betas. Ready? So I'll give you my example of what exactly I want you to do, so you can see what I'm leading you towards. So let's assume I sell an asset. What happens? On the asset side of the balance sheet, I'm going to replace the asset with cash, just like I sold the food. What happens to my unlevered beta? My unlevered beta will decrease. Why? Because I've replaced a risky asset with an asset with a beta of 0. What happens to my debt to equity? Nothing. I just sold the asset. I didn't tell you what I did with the cash. The cash is still sitting around. So debt to equity is unchanged, and my levered beta is now therefore going to go down because my unlevered. So you kind of get where I want you to go? So let's try a second one. You buy an asset with cash on hand. So help me out here. So first, what happens on the asset side of the balance sheet? Asset side of the balance sheet, you buy an asset with cash on hand. You're going to replace one asset with another. So the value of but you're replacing a riskless asset with a risky asset, right? What's going to happen to your unlevered beta? It's going to increase because you replaced a safe asset with a risky asset. What's going to happen to your debt to equity? Nothing. You see, but I'm paying cash. You see the urge you're going to feel to try to adjust the equity for this? Nothing's happened to debt to equity, so my levered beta is going to go up. Everybody clear on that? So I've replaced a riskless asset with a risky asset. My unlevered beta is going to go up. My debt to equity doesn't change. My levered beta is therefore going to go up. You want to help me on the next one?
Oh, man.
So that's okay. I'll help you along. You buy an asset with a new stock issue. Let's start with the asset side. So you buy an asset, what's going to happen? The asset side is going to get bigger because I brought a new asset. Will the unlevered beta increase, decrease, or remain unchanged? Just visualize the asset side. You brought in a new asset with its own beta, right?
Yeah.
So the beta for the company will be a weighted average. It depends on what you bought. You bought a social media company with a high beta, bringing it in is going to push up your beta, right? You buy a utility with a really low beta, so the effect on the unlevered beta will depend on how risky the business was that you bought. So it depends.
Yeah.
What about debt to equity? How did I fund it?
Equity.
So my equity will go up. My debt to equity is coming down. My levered beta, God only knows, right? It depends on what happened to my unlevered beta. If I gave you a problem, God only knows would not be the answer. I would tell you what you bought, but you can see the working through. So you want to help me on the next one? No? Come on, you can do it.
We're all friends.
Yeah. Buy an asset with new debt. It's actually, he did the hard work for you. So let's do buy an asset, new asset. The first two pieces are going to be exactly like the last one, right? You buy the asset, depending on whether it's safe or risky, your unlevered beta could go up or down. But I use debt instead of equity. So what happens to my debt to equity ratio? I borrowed the money to fund it. It's going to go up.
There you go.
And my levered beta is going to reflect the higher debt to equity ratio. Separate the two actions. The buying the asset is exactly the same effect, but the fact that I used it. What if you pay a dividend? Wait, where do they? So I should have been more specific. I have to pay the dividend. If I have to pay a dividend, the money has got to have come from somewhere. So let me be more specific. Pay the dividend with cash on hand. So the asset side is going to, the cash is going to decrease. So the assets, what's going to happen to my unlevered beta? Almost, it's going to go up, exactly. Tell me why. Because the safe cash left the company, right? So my unlevered beta is going to go up. What happens to my debt to equity?
Sorry, you pay a dividend, so your equity goes down.
Exactly, you got the thing. So you get debt to equity goes up, your levered beta will now reflect the change. What if you buy back stock?
Cash goes out and
So the asset side will get smaller. Unlevered beta will?
unlevered beta will, if cash and assets get smaller, unlevered beta gets larger.
Larger. Debt to equity will
Be reduced.
be reduced. I bought back stock.
Okay, so also larger.
It'll get larger, and my levered beta will reflect. So in fact, that's keep the financial balance sheet in front of you, right? So it'll all just play with the numbers. What if I retire debt? First, cash leaves the company, so my unlevered beta will increase. So taking a safe asset out, debt to equity obviously will decrease. My levered beta will actually go up. It's strange because people say, well, I took cash and paid out debt. Why isn't my risk changing? Because debt created a tax advantage that is now gone. So there's this subtle, and that's why my problem with net debt ratio approaches is they act like cash and debt are really equivalent, but they're not. You're a risky firm, cash is truly riskless. Your debt is not riskless. We're netting them out as if they were. And I can see why people do it. It's a nice, convenient way for a lot of European and Latin American analysts to deal with debt and cash. But I prefer to treat cash for what it is and debt for what it is. So, yeah, go ahead.
Just briefly, in general, if a tax rate is not given, should we assume the 40% that you?
Any number I should have given you that I've just given you a license to do whatever you want. Make your life simple. What's the easiest tax rate to assume if you're from a calculation perspective? 0. Why do you even need a tax rate? If I don't give you a tax rate, say since you don't give me a tax rate, I'm going to act like I'm in the Cayman Islands. I have a 0 tax rate. So that's my mistake. Take full advantage of it. Most of the time though, when you think you should be given something and it's not there, it's because you don't need it. And if you're looking for it too long, then maybe you're down the wrong path. I don't know which path, so you have to decide which one it is. Now, but what I would suggest is take those problem trees. The first time you do it, you'll see all this stuff coming at you. You do this and you do that, and your reaction will be to try to deal with all of them at one go. Don't. Take it piece by piece by piece, just like we did in this table. What's being changed on the asset side? Where is the money coming from? Work out the unlevered beta, work out the debt to equity, work out the levered beta. I promise you, if you follow the steps sequentially, you will not get into trouble. If you try to jump steps, so do I need to unlever and just re-lever? That seems like a lot of work. I just stay with levered. You are always going to get into trouble because something will have changed under the surface and you're not bringing that in. One final point, and I don't know why this confuses people, but I really want to make sure it doesn't confuse you. Remember I said when I say beta, I mean levered beta unless I specify otherwise? When I say debt ratio in a company, I'm usually talking about debt over debt plus equity. It's debt to capital. So when I tell you the debt ratio for a company is 20%, I'm saying this company is 20% debt, 80% equity. But in almost all the levered beta calculations, you don't want a debt ratio, you want a debt to equity ratio, right? So if I give you a debt to capital ratio of 20%, to convert to debt to equity, what do you need to do? Just put in a number, right? Say, let's assume the firm is $100 firm. Work with 100. It's always easiest to work with. If $20 is debt, $80 has to be equity. So the debt to equity has to be 20 divided by 80, which is 25%. You should be able to move back and forth between the debt to equity and debt to capital. This is plain algebra, right? So don't worry about the very, very narrow details. Okay? Don't write out 100 equations on your lookup sheet. Either write 2 equations or no equations at all. Because ultimately we're working with the same 2 equations over and over. If you look at so if you have different equations for a stock buyback and dividend, each of these, it's just going to confuse you. Okay? So draw the financial balance sheet, work with it, see if that helps you. And that's about it. I will see you on Monday. And try to go to the rooms that I asked you to go to. I'll send it out again because you're trained never to have seen it before, so I will do it one more time. And I'll send this, as soon as I get the link for this webcast, I'll put it up with the review slides, and you can work on it. Somewhere. So whatever that cell is, you can set it to. I'll fix it. It should take a 0. So that was probably something happening when I multiplied through.
Yeah, something happening.
Remember your last So they have to be shown The yacht is on the shoulder, Alibaba, as part of cash. Those are shares, those companies. Some of it is overseas. It's not related. Bringing that cash back would be cash. Expected in any financial context, it's expected to be a discovered fact, not a experiment, but as a required regulation. The buyers will produce something for 10 minutes. He has to make the cash flow on the company. The discounted cash flow using the rate of 1 but that's why I said you're going to overpay for that social media. It's really a $6 billion company paying $10 billion.
Oh my God.
Then the consequences. Because your asset value will actually be the true asset value of $6 billion. And your equity will now have to lose the $4 billion. And that's where if I specify an acquisition, assume it's a fair value acquisition, it makes your life simple. Because if it's anything but a fair value acquisition, there can be consequences.
Buy some new assets, finance, buy new debt, assets up, and also debt to equity, also both betas.
Depends, right? But the asset you bought might have been less risky or more risky than your assets, right? If you buy a social media asset, your answer is right. But if you buy this really, really safe asset, so that's a little tricky. The asset side depends on what your existing assets look like.
Okay. Retired assets.
With what? Retired cash assets.
Debt to equity.
Yeah. And another beta. Because cash flow.
Sorry, I no, I get who they are. Yeah, I'm like, no, I'm not in the bottom 10, but I'm like, my score, I just keep dropping and dropping. You go to the top, yes, but you have like, you have to, so like, well, she's drilling.
It literally says that. Sitting on the flat.